James Rickards is publicly saying 24,000 an ounce. Mike Maloney, 10,000 an ounce. It's as simple as them revaluing gold, telling the president tells the Treasury secretary to revalue gold, who tells the Federal Reserve. They're issued gold certificates. The Treasury issues the Fed gold certificates, who then every $4,000 increase in the price of gold, the Treasury general account will get $1 trillion free and clear. Understand gold very well. They subsequently closed their gold division. They're not a primary distributor anymore, but their head trader just came out and said their next stop is 6,600 on gold. Counts for 1/4 of China's silver production. It's known as the silver capital of China. They're basically all out of stock. India, as you mentioned, their largest precious metals refinery has ran out of silver stock for the first time in history.
Andy Schectman, a veteran precious metals analyst and CEO of Miles Franklin, recently discussed growing expectations for a significant gold revaluation. He pointed out that leading voices like Jim Rickards and Mike Maloney foresee gold being officially reset to between $10,000 and $24,000 per ounce, a move that could instantly recapitalize the U.S. Treasury. Schectman explained how such a revaluation would work. The Treasury instructs the Fed to reprice gold, issues new gold certificates, and credits trillions to its account for every $4,000 increase. Meanwhile, global supply chains are tightening. China's silver capital is running dry, and India's largest metals refinery has reported its first ever silver shortage. These developments, he warned, underscore how rapidly physical scarcity is reshaping global finance. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
On Monday, Bank of America raised its forecast for silver to 65 by the end of next year, and gold to 5,000 by this year. But we're going to talk about Bank of America too. Goldman Sachs, they came out and said if the market even senses for a moment that the Federal Reserve has lost its independence, you'll see gold at 5,000 like that. Well, you look at Stephen Mirren. Stephen Mirren is the architect of the Mar-a-Lago Accord. Stephen Mirren was Trump's advisor, still is, and he filled the vacated spot at the Fed. What independence? There is no independence. You look at Bo Hines, I think is his last name. He was Trump's crypto czar. He is now running USA Tether. The whole system is lacking independence. So Goldman Sachs is more or less telling you $5,000 an ounce gold. I mentioned Bank of America. You look at their high buck analysts, a guy that sends out letter, and these people I'm mentioning, they're talking not to the plebes, they're talking to the institutional traders, because Michael Hartnett's letter, I don't know how many tens of thousands of dollars it is a year, but he's a smart dude, a very smart dude, and he just came out and he said, well, let's go back 1 second, because before that you had Morgan Stanley, and their chief investment advisor, CIO, says, no more 60-40, 60 stock, 40 bond. Let's go 60-20-20. Sell 20% of your bonds and buy gold. So they're saying 60% stock, 20% gold, 20% bonds. Never happened before, right? Most financial advisors would say, fine, 5%. They acquiesce. Now they're saying 20% and cut half your bond holdings. Back to Michael Hartnett, the big buck analyst who speaks to the high institutional level traders and clients. No, not 60-20-20. He says 25-25-25-25. 25 stock, 25 bond, 25 short-term treasury paper, 25% gold. Really interesting. Never heard that before. How about Jefferies? Now, Jefferies means a lot to me. About 20 years ago, Prudential Beige nominated Miles Franklin to be an authorized reseller for the U.S. Mint. At the time, there were only 27. They don't really talk about it too much anymore. It's even hard to find. You got to call the Mint and ask them. But we're one of 27 to my last count. I don't know how many more have been nominated. They can do one per year, the primary distributors. 1 of 27 authorized resellers. So that was Prudential Beige. But Jefferies bought Beige. And for several years, Jefferies was a primary distributor for all of the world's mints. They understand gold very well. They subsequently closed their gold division. They're not a primary distributor anymore, but their head trader just came out and said their next stop is 6,600 on gold. But maybe the biggest one of them all is Jeffrey Gundlach, the bond king, the man who made his mark on selling bonds, right? The antithesis of gold, a safe haven asset, but pays a yield, right? He says 25% of your assets in gold is not undervalued or is not overvalued, excuse me. So you have the most sophisticated traders on Wall Street. You have the most high-paid buck analysts, including chief investment officers, all whistling a very different tune as it pertains to how much gold should be in people's inventories and in their holdings. And the people they are speaking to are the big money, big buck people who position well before the crowd does. So this noise that we saw on Friday, this pullback that everyone freaked the hell out about after the price of gold and silver had been going up nonstop, the market needs to exhale too. The big traders do take profits. But look, here we are right now, pretty damn close to where we were when the market got whacked on Friday, with gold up $60 right now to 43.12 and silver up to 52, almost 52 and a quarter. So yeah, it's buying the dip is the way to get ahead. But even more appropriately, if you don't understand, none of us do really, where things are going, I see a primary trend going much higher for a myriad of reasons that I can talk to you about. But if you're not sure, then cost average. Let purchasing over time smooth out the uncertainty. And that is the only way to do so, because really none of us know what the hell's going to happen tomorrow. I think you just have to sometimes trust your gut. And if you're uncertain and feel a little queasy about making a large purchase at a certain time, even after it falls, which is buying, catching the falling knife is hard, cost average your position, and over time that will smooth out the uncertainty. Andy, July 4th, 2026 is a very, very big day for President Trump. It is the 250th anniversary of the United States, and he is going to reconnect gold to the Treasury market, to the back end of the bond market, the long end. And in her book, As Good as Gold, she says 50-year Treasuries will be the long one with a tiny, tiny bit of interest, 0.5%, 1%, something like that, redeemable in gold. She goes on to say 5, 10, 20, 30, and 50-year Treasuries in her book. All right, so follow me here. You have a Secretary of Treasury who wants to preside over a new system. You have Stephen Mirren, who's at the Fed now as the advisor. The Mar-a-Lago Accord, devalue the dollar, bring back manufacturing. You have Trump talking about bringing back manufacturing, starting with tariffs. We've got to bring back manufacturing. And you know what, Daryl? If we don't, our kids are dead, and their kids are even more dead. We don't make anything anymore. AI is going to kneecap jobs. 60% of America has no college education. No one's got savings. We need to bring back manufacturing, period. Okay, how do you do it? The strong dollar, and Triffin's dilemma says you can't do it. No one will buy our stuff. The dollar's too strong. The cost of employment, everything, labor. We don't have any manufacturing anymore. We've sent it all offshore. How are you going to reshore everything? All right, I got you. So if Judy is right, first and foremost, and they do peg gold to the back end of the Treasury market, first, you have to let it go much higher. Now, what has gold been doing? Stair-stepping, 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 outpacing everything, and no one notices it. And people look at Bitcoin and they look at NVIDIA. They don't notice gold, that it's outpaced everything. They don't notice that it was up 40% last year, over 50% this year. That's not sexy enough unless it's triple-digit gains or something like that, but they don't notice it. Now, I believe that they are going to let it go much, 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 much higher and then revalue it. Revalue it, even if they just market to market at that point. Right now, it's valued at $42.22 an ounce. James Rickards is publicly saying $24,000 an ounce. Mike Maloney, $10,000 an ounce. It's as simple as them revaluing gold, telling the president tells the Treasury Secretary to revalue gold, who tells the Federal Reserve. They're issued gold certificates. The Treasury issues the Fed gold certificates, who then every $4,000 increase in the price of gold, the Treasury general account will get $1 trillion free and clear. So if they moved it to 24,000, hypothetically, not only would it benefit every central bank on the planet who's been buying it, but in essence, it would allow the Federal Reserve to receive those gold certificates, for which, in theory, at least it says so in all the documentation, that they hold the gold, but it's not theirs. They're entitled to the fiat value of the gold. The gold belongs to the American people. They push a button, create $6 trillion, and give it to the Treasury, which devalues the dollar massively. Devalues the dollar massively. The higher the price of gold goes, it's not even the gold price, it's the devaluation of the dollar. That's what they want, the debasement. They're debasing the value of the dollar by letting gold and Bitcoin go higher and higher and higher and higher.
Andy Schectman outlined how major financial institutions are now openly preparing for a dramatic repricing of gold. Bank of America expects $5,000 gold by year-end, while Goldman Sachs warns that any sign of Fed political influence could send prices there instantly. Others, like Jefferies and Morgan Stanley, are recommending gold allocations of up to 25%, levels never seen before and institutional portfolios. Schectman explained that revaluing gold could effectively recapitalize the U.S. Treasury, generating trillions in new liquidity by marking gold closer to its actual market value. He believes this could form the backbone of a new monetary system, one designed to devalue the dollar, restore manufacturing, and ultimately reset the balance of global finance. Let's get into the interview.
Yeah, you got China sold out of silver supposedly, and I had to put my glasses on because I don't know how to say this. It's Shirazu, Hunan province. So it accounts for 1/4 of China's silver production. It's known as the silver capital of China. They're basically all out of stock. India, as you mentioned, their largest precious metals refinery has ran out of silver stock for the first time in history. Again, this is massive demand for physical. You have at the same time London with the lowest amount of silver, the float that they've had in the history of the exchange, of 140-year-old exchange. They have less than 140 million ounces, yet they're trading 600 million ounces a day off that stash. What could possibly go wrong? There's between 1 and 2 billion ounces of contracts that could stand for delivery with only 140 million ounces available. At the same time right now, you have the U.S. government who just reclassified silver a critical mineral. At the same time, you have 19% lease rates in London, the highest it's ever been to my knowledge. So people who need to borrow silver to get whole, to cover a short position, they're paying 19% lease rates. So everything we'll see, you look at your bank account, you'll see dollars, but when you move it, it goes through the USA Tether network and settles instantly, which are all backed by short-term treasuries. Now, here's the kicker. They get to keep the spread between the issuance of treasuries and the stablecoin. You as a stablecoin mover, you're not getting the interest on that, on what's standing behind it. Short-term treasuries, they are. But with those, the profits, they're required to buy more short-term treasuries to push rates down, and gold and Bitcoin. They already own over 8 billion in gold held in Swiss vaults. They were just at the Beaver Creek Summit, which is with all the miners, right? They are interested in buying gold and more short-term treasuries and Bitcoin with all of the proceeds that everything is moving on all throughout the world will be backed by this stable coin, pushes rates down synthetically. And with the profit, they buy gold, which pushes gold up, which does what to the dollar? Deflates the dollar, depresses the dollar, right? Pushing the dollar down. Exactly what you're talking about. Same thing with Bitcoin. How do you pay off your debt? Let Bitcoin go to the moon because they continue. Look at how much gold Tether just bought the other day. Billions worth. Billions. They pushed Bitcoin up, and I'm not even a Bitcoin guy, but they're going to try and pay off the debt with it. The Russian finance minister is right. They'll let Bitcoin go up and they'll start to pay off the national debt. But by letting gold go higher and higher and higher and higher and having a mechanism that continues to buy it, plus all the gold coming in, billions and billions and billions, makes the gold stash go higher, sure. But then it also devalues the dollar. Now let's put it all together. How do you bring back manufacturing? I know you peg gold to the back end of the bond market like Judy Shelton is going to happen next July 4th. You bring it back at zero upfront borrowing costs. How do you sell your product to the world? You give up on the reserve standard and you massively devalue the dollar by letting gold and Bitcoin go to the moon.
Andy Schectman concluded by highlighting how global physical silver shortages are converging with a structural shift in the financial system. China's top silver-producing province is reportedly out of stock, India's largest refinery has run dry, and London's inventories have fallen to record lows, just 140 million ounces backing billions in daily trading. At the same time, lease rates in London have spiked to 19%, signaling severe stress among short sellers. Schectman connected this to a broader monetary pivot. Stablecoin systems like US Tether, now heavily backed by short-term treasuries and gold, are quietly reshaping liquidity flows. Their model pushes yields down, lifts gold prices, and accelerates the dollar's controlled devaluation. Behind the scenes, he argued, a global monetary reset is forming, one built on hard assets, not promises. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.